meeting, I'm seeing you first time, of course, virtually. At that time, we had the luxury of seeing each other physically.
Yes, sir. Thank you very much for inviting this.
No, I must thank both of you. You see the number of registrations, number of inquisitions, and all these things. So the topic and both of you, and particularly in association with the PIMDA, what we did, I think as rightly said by Mr. Sabnavis, this market volatility has added to the interest.
Yes, sir.
So,
Yeah. I just want to check if you are able to hear me clearly.
Yes.
Yes, sir, we can hear you.
We loud and clear. Sidhan Sahab, you can just speak a few words, let us see.
Yes, I can also hear each one of you clearly.
Yeah, by it.
Okay, sir. So I think we should start now. It's already 3 p.m.
Right.
Okay. Good afternoon, ladies and gentlemen, and a very warm welcome today for the session. A joint webinar held, hosted jointly by Indian Institute of Banking and Finance and Foreign Exchange Dealers Association of India. So my name is Preetham and I will be your host today. So they say that an investment in knowledge, it pays the highest ROI, especially if that knowledge concerns the knowledge of the markets. And that's what exactly we will be talking about in the next 1.5 hours, wherein we have two of the best minds of the industry today to share their insights about the topic INR in 2022-23. And that too on a backdrop where there is a war waging in the Eastern European borders, and that is jeopardizing the whole nascent recovery post-pandemic economies all across the world. And also the spiraling inflation trends that we have seen globally, fueled by the petroleum prices and also the commodity prices. So the topic gets even more interesting. So I take this opportunity to welcome all our distinguished guests. First and foremost, two of our speakers, Mr. Madan Sabnavis and Mr. Neeraj Gambhir. And also I welcome Mr. Biswaketan Das, CEO, IIBF. I welcome Dr. S. Muralidharan, Director Academics, IIBF. I welcome Mr. Ashwini Sindwani, CE of FEDI. And of course, for the introduction of our speakers today, I will have a separate time because that takes lots of accolades, right? So Mr. Madan Sabnavis is the chief economist of Bank of Baroda. He has been a corporate economist for about 35 years and has worked with erstwhile ICICI Limited, ICICI Bank, L&T, NCDEX, and Care Ratings. He is a postgraduate in economics from Delhi School of Economics and have graduated in economics from St. Stephen's, Delhi. He has authored 5 books, the latest being Lockdown or Economic Destruction, and has over 2,500 articles written since 1988 on various business and daily newspapers. He is on the committee of SEBI and IIBF and have in the past headed the economics and business committees of BCCI and IMC. Our second speaker today, Mr. Neeraj Gambhir, is the Group Executive, Treasury Markets and Wholesale Banking Products of Axis Bank since May 2020. He has over 25 years of experience in the financial services industry with expertise in fixed income, foreign exchange, capital markets, structured finance, derivatives, risk management, and investment banking domain. Previously, he was the MD and head of fixed income for Nomura Holdings, India, where he set up and grew the fixed income business. Prior to that, he was the MD of Lehman Brothers India and an SGM and global head of structured finance and balance sheet management at ICICI Bank. Mr. Gambhir is a board member and former chairman of PIMDA. He had actually helped to establish the Clearing Corporation of India and was a nominee director of its board. He was also the vice chairman of task force set up by Ministry of Finance, Government of India, for establishing a public debt management office. Additionally, he was involved in Indo-Japan discussions for financial cooperation. Mr. Gambhir holds a Bachelor of Engineering degree in Computer Science and is a postgraduate in Business Management from IIM Lucknow, where he was awarded the PGP Chairman's Medal. So with these two established and distinguished members, distinguished speakers, I will now hand over the podium to our CEO, Mr. Biswaketan Das, for the welcome address. Over to you, sir.
Yeah, thank you. Thank you for the introduction. Let me welcome first the participants. Today we have got overwhelming response to this series, member education series, which are being conducted in association with Foreign Exchange Dealers Association. In fact, I must thank Mr. Ashwini Sindhwani for his interest and finding a topic contemporary to the present scenario. I welcome all the participants here. It is being live streamed in Facebook as well as in YouTube. Many of them are also joining there. But let me first welcome the two speakers. Mr. Madan Sabnavis, who has been quite a well-known face in Indian economic system through his articles, articulative discussions which he used to have at various forums, the books which he has written, and today he is with us to discuss about the fate of INR in 2022 and 23. We have with us Mr. Neeraj Gambhir. Welcome, Mr. Gambhir, who was my close associate in my earlier phase in Treasury and FIMDA. And having known him personally and seen him and listening to him personally, I am sure all the participants will have the glimpse of his analytical mind and the articulation in regard to the rupee. Many of these participants are from the Treasury. If I am not wrong, most of them have the Treasury of different banks have also joined here to listen to you. I welcome both Mr. Madan Sabnavis and Mr. Gambhir to this member education series webinar. I welcome the Chief Executive of FEDI, Mr. Ashwini Sindhwani, with whom we have a very, very long association. And in fact, the capacity building course on foreign exchange is being run in association with FEDI. When we see the rupee or when we feel the rupee in India, perhaps many of us, we do not understand if rupee is valued at 77 or 52 vis-a-vis dollar. So how it will unravel in the near term, how it will unravel in the long term, what will be the effect on the common people other than the dealers? If rupee depreciates, most common sense is that if rupee depreciates, our export will grow. Whether that is actually true, whether we should allow the rupee to depreciate, or RBI should come and stem the rupee falling, and how do we do that? All this is if you see the rupee per se, it is not rupee per se. It is the reflection of the Indian economy. It is regarding the trade deficit, it is regarding our own inflation, it is regarding our export, import, everything combined together is manifested in rupee. So, I expect all the participants to have a greater view of the implications of movement of the rupee and how it will happen going forward. But I think with this, I will not take much time, because the time belongs to today to our distinguished speakers. I welcome both the speakers once again and welcome all the participants.
Thank you, sir, for the welcome address. I would now invite Mr. Madan Sabnavis, Chief Economist, Bank of Baroda, to share his perspective, an economist's perspective, on INR in 2022-23. Over to you, sir.
Yeah, thanks a lot. And first of all, I'd like to thank IIBF and FEDI for having me on this particular forum. I do feel privileged and honored to be out here and speak to an audience who probably are better educated than me on this particular subject. Now, when Dr. Muralidharan had first broached this particular subject, I think it was maybe a few weeks back, on the INR in 2022-23. I think the perspectives were quite different from what they are now, because the kind of developments which have taken place, I think the narrative has been changing by the day. And there is more uncertainty when it comes to guessing or conjecturing as to where exactly will the value of the rupee finally land up in this particular financial year. Now, in order to understand this, as an economist, the way we would look at it is that we look at around 3 or 4 things which generally keep driving the currency. Okay, one is what I would call fundamentals. The second is an external factor, an extraneous factor about what is happening in the global economy, what's happening to the dollar. The third is trying to guess or second guess what the Reserve Bank of India is going to do. And then there's a fourth factor, which I would say is more conceptual in nature, which I don't thoroughly agree with, but it's nevertheless an important factor. And any discussion on the rupee also will refer to the RER, which we keep talking of, the real effective exchange rate. So these are the 4 factors which to my mind would be at the back, which would be driving the value of the currency during the financial year. Now let's look at the fundamentals. Now, when we look at the fundamentals, I'll say, where are the dollars coming? Where are the dollars going? Because at the end of the day, if you're looking at the currency, it's like any commodity where the price has to be determined by the demand and supply. So in case I see that the demand for dollars is going up relative to the supply of dollars, which is probably coming down or not keeping pace with the kind of requirement which is there, it would be a natural tendency for the rupee to depreciate. So what are these factors which we're looking at? We would look at the balance of payments of the economy. When I talk of the balance of payments, it's nothing else but an account of the external account of the economy, which talks of where are the dollars coming and where are the dollars going. So we have 2 parts to it. We have what we call a current account and we call a capital account. So let's see what are how these 2 things, these 2 elements are going to move during the course of the year. First, if I look at the current account, which is normally the area of focus, because we've heard lots of people saying that what was a surplus in 2021 is going to turn to a deficit in 21-22, and probably in 22-23 we'll be having even a higher current account deficit. So what exactly are we talking of? At the current account level, the most important factor is the trade deficit. That is the result of exports and imports. And today we've had a situation where exports have been booming. We've crossed the $400 mark last year. And it looks like that the momentum which was set forth in 21-22 is probably going to be maintained. The month of April showed that exports had grown by over 20%. But the mirror image out here is that whenever exports grow, we also see that the imports keep increasing. And I think that's become a worry point for all of us. Because imports is when an economy is recovering, there's a tendency for demand for imports to go up. So demand for dollars or foreign currency keeps increasing. And accordingly, there is a case of saying that there is going to be pressure in terms of demand. But there is this other factor which has come in on account of the war, which is that commodity prices have started increasing. And intuitively, one can see that when India or any country has a high trade deficit, last year it was in the region of around $200 billion. So notwithstanding the fact we touched $400 billion, we had our imports, which were around over $600 billion. So if I'm going to import more than I export, then it's but natural that we would, the demand would be greater than supply, and there would be a tendency for a depreciation. So that's one of the major factors we have seen in the trade deficit, which is very high and will continue to remain high, not just because of the Indian economy, which seems to be on the recovery path, while there will be some element of a slowdown on account of what's happening in terms of high inflation and probably the RPI increasing interest rates. But on the whole, we are still talking of an economy which is going to grow at 7+%, which is going to lead to a greater demand for imports, which are going to come at higher cost. So when we have a high trade deficit, that itself is an alarm bell for the current account deficit, because if you look at the other elements, there are 2 elements which normally tend to be positive and would carry on to be positive, though we're not quite sure about what will be the acceleration in their growth. One is the software receipts and the other are remittances. So these 2 have typically provided something like $175 to $200 billion on an annual basis. Now, will this continue in the current financial year? There's, of course, a question, because when we're talking of some kind of a slowdown in the global economy, because the global economy is not going to do as well as we thought at the beginning of the year, primarily on account of the war. and the fact that most of the central banks are going to try and restrict the overall demand forces. So this really means that even in terms of remittances, the kind of opportunities which are there in other countries for our expat population, that could be some kind of a slowdown. Similarly, when we're talking in terms of software receipts, normally it goes along with growth. So if the world economy is growing, software receipts are going to keep increasing. So in this kind of a situation, there could be some kind of a pushback on account of the slowdown, which is likely to happen, which means that even in terms of other current account receipts, it would not be as buoyant as what they were in 21-22. So what we are looking at is a kind of a current account deficit, which could be in the region of around 2.5% to 3% of GDP. So that's actually a starting point of the fundamentals, saying that if I have a current account deficit, which earlier was a surplus, there is definitely a reason for us to believe that there's going to be pressure on the rupee. Now, how has this been countered in the past? It's basically by the capital flows. And here, I think I would highlight three particular points. We can look at FDI, we can look at FPI, and the third is the external commercial borrowings. Foreign direct investment, we have seen, has been bringing in something like $80 million on an annual basis. But there's a question mark about saying that, will this be replicated in 22-23? One doesn't really have a clear answer because we have a situation where interest rates are rising outside. And if you're an investor, you're also seeing there are opportunities taking place in the Western world. So will there be a same kind of deployment of resources to the emerging markets? Because we should remember that one of the reasons as to why both FPI and FDI increased in the last decade or so is because of the quantitative easing. So we have a quantitative easing by the Federal Reserve, by the ECB, the Bank of England. So what really happened was there was a lot of liquidity, and what investors did was they picked up this money, and a large part of that was really invested in the emerging markets. So this is one of the unintended consequences of quantitative easing. Now today we have a situation where quantitative easing is being rolled back. And I think all the central banks are talking of saying that that's the end of easy money. It's not just that the interest rates are going to go up, but also there's going to be a rollback, shrinking of the balance sheets of central banks. So this means that even though I'm quite sanguine that we could still probably be seeing FDI in the region of around $80 million for the third successive year, but any kind of an acceleration of which we'll have to view with caution. If I look at foreign portfolio investment, I think FPI has been very, very whimsical in the last few years, sometimes going positive in equity, sometimes positive in debt, sometimes negative in both. And currently the situation, it doesn't really look too bright. So we are still in a negative zone. Last year was negative. Year before last, in the pandemic year, it was positive, equity positive, debt negative. So I think the FPIs, which earlier could be relied upon to get something like $30 to $40 billion, would probably be in a negative territory. Why again? Because when you're talking of a situation where interest rates are rising in the West, and while one does expect the RBI to keep increasing interest rates further, but it may not be as aggressive as what we're seeing in the US, or probably even at a later stage by the ECB, which really means that investors may be looking at other destinations. They may not be looking at the emerging markets, or if they're looking at the emerging market like India, they'll be weighing it with what are the interest rates in the other kind of in other economies, and accordingly take a call on it. So with FDI to be more or less stable, FPI whimsical, probably negative, at best possible case, maybe marginally positive. I think two particular elements are not going to be too favorable. The third thing would, of course, be ECBs. Now, in the past, we have seen that Indian companies have been fairly aggressive in terms of borrowing through the ECB route. We have gotten around $30, $40 billion at the best of times. Now, will this be replicated? Big question mark again, because with interest rates rising overseas, domestic interest rates are also going to increase, but may not be to the same extent. The kind of an advantage which one had in terms of borrowing from the external commercial borrowings market may not really be there in this current financial year. And add to this kind of a chicken and egg situation when the rupee is volatile, interest rates are high overseas, the exchange rate risk will also increase. So are companies willing to borrow and take that kind of a hedging position? Hedging costs may not be too favorable at this point of time. So therefore, ECBs may not be the preferred route to a very large extent in this current financial year. So therefore, I would tend to believe that the fundamentals would dictate that there could be a kind of a pushback, and there would be a case for the rupee to depreciate. Now, the ultimate answer to the demand supply, whatever happens in the balance of payments, is the change in your forex reserves. Now, we have seen our forex reserves going up to around $640, $650 billion. Subsequently, we have seen that the forex reserves have been coming down. Today, we're just marginally below $600 billion, not because of the demand supply thing, because RBI has been selling dollars. They have been getting into these swap arrangements with banks, providing dollars so that they're able to steady the rupee. So this is something I'll talk a little bit more about when we're talking of the RBI factor. But suffice to say that the fundamentals may not be leading to too much of augmenting of the forex reserves. They could be declining. How much they will decline could be anyone's guess, depending upon how the trade deficit actually behaves, how the FPIs behave. But on the whole, we cannot feel as confident about the forex exchange reserves increasing as we were at the beginning of last year. The second factor we need to look at would be the external factor. What is happening to the dollar? Because we have seen that whenever the dollar appreciates, it becomes stronger. There's a tendency for most currencies to weaken. So even today, I remember in Monday morning when we got up and we got to know that the rupee was taking a severe hammering, first thing we did as economists was try to see what's happening to other currencies. And what we realized is that India was not an isolated case. It was happening to virtually all currencies. And we may have memories that the euro-dollar rate was 1:1.20, came down to 18, 17, 15, 16. Now it's 1.05. We're nearing parity. Now, why is it that the dollar is strengthening? The dollar is strengthening because American economy appears to be strong. Federal Reserve is trying to pull back. They're trying to increase rates. They want to deflate the economy because there is strong reason to believe that the economy is overheating, with unemployment rates also coming down. So when the dollar becomes stronger, and it's likely to remain strong for the rest of the year, there is a reason for us to believe that there will be pressure on the rupee, including the other currencies. In fact, we've been doing this analysis almost regularly, picking up the top 20 currencies and seeing as to how does the Indian rupee really fare. We would be probably somewhere at a median level. So if I'm looking at around 20 currencies and look at who all are depreciating, we'll see that India is actually not doing that badly. Okay, at any point of time, we're doing it almost on a monthly basis. We see that India is not somewhere at a median level, but the fact is that we need to depreciate. And this is something which may probably be a necessity, because when we talk of what the RBI is looking at, there's always this feeling that a weaker rupee is something which would be helping exports. Nothing has been conclusively proved, because I would tend to believe that global economic conditions are more important. But the fact remains that if other currencies are depreciating and I'm not depreciating, there would be a tendency for me to lose my export competitive advantage. And therefore, to some extent, I think there's a lot of comfort which is there when the rupee is depreciating, when other currencies also depreciate. So this is another factor which will continue to be fairly negative in terms of the strength of the rupee, so which will be pointing towards a depreciation. Now, this brings in the important factor of the RBI, because all the time when we talk among ourselves, the first thing is that what is the RBI going to do? Because we have seen that when there was a time, I think maybe a month and a half back, late February, where people spoke of the rupee touching 80 rupees to a dollar, we had seen that the RBI had come up with the swaps. There has been intervention in the market. There has been intervention in the forwards market, in the NDF market. So whatever the RBI does, it also helps to strengthen the rupee. So there's a case of saying that, well, today, if you ask me where do you expect the rupee to go, I may say maybe 79, 80 by the end of the year, but that's all contingent on what could be happening as far as the RBI does. Because when the RBI starts supporting the rupee, there's a tendency for the rupee to sort of regain its strength, or the depreciation or the slide is arrested. So this is something which is it's not known. And I think the RBI has continuously reiterated that they are not looking at any particular value of the rupee, but they want less volatility. They don't want too much of speculation to take place. Because the situation is fairly crazy, because when the rupee is depreciating, market expects the RBI to say something. They expect the RBI to intervene. If the RBI does not intervene, then it's assumed that the rupee should be falling further, and the rupee will fall further. Exporters will hold back, importers will rush in, the demand supply is exacerbated, and the rupee starts depreciating. If the RBI starts intervening, the question is that how much can the RBI intervene? Can they keep putting $5 billion on a monthly basis, $10 billion on a monthly basis? It's not a bottomless pit. While we have a fairly good set of reservoir of dollars, of $600 billion, but we cannot exhaust everything trying to defend the rupee. So I think that's another factor which comes in as to how much will the RBI intervene, and in what way is the RBI going to intervene? Is it a case of providing dollars directly in the market, or through the NDF market, or through the forwards market? But that's another important factor which we have no clue as to what the RBI is going to do. So we have seen even in the last couple of days, there has been news that the RBI has, I think Neeraj will be in a better position to explain, he's in the markets, and as to how much has actually been the intervention of the RBI to steady the rupee. So this will be an unknown factor which can actually make most of our conversation out here meaningless, because if the RBI intervenes in a big way, the rupee may suddenly stop sliding, it may start appreciating. So that's an unknown factor. And the last factor we look at is the RER, so the real effective exchange rate. Now, the RER is not something which I, as an economist, I'm particularly for, but definitely that's a factor which is looked at, because the way we define nominal multiplied by our inflation compared to world inflation, currently, if we look at it, the rupee seems to be fairly well valued, I would say, because we have seen that the RER has been moving in a similar direction. I think it was 103 or so for the latest information provided by the RBI. So that's another factor, and given the fact that our inflation appears to be less scary, at least I don't know what's going to happen at 5:30 today. Will the inflation number be higher than that in the US? We're talking of inflation of 8% in the US. India is probably in the region of 7%. So is our inflation actually lower than that in the US, which means that our RER will also be in the right position? That's another factor which comes into play when we are talking of where the rupee will go. So if I have to combine all these factors, as I told you, it will be very, very audacious for anybody to take a call about how the rupee will behave, because while I could be sure that the fundamentals are going to not be very favorable, there'll be a case of depreciation. Rupee is definitely going to strengthen. I'm not quite sure about how the RBI would be behaving. And as an ex-post explanation, I don't really know how the RER is also going to behave. But the way we look at it is, it's more a case of adaptive expectations. We keep testing the value of the rupee by a rupee. When I say a rupee, we look at a range of earlier 76 to 77. Now we're talking of 77 to 78. And given the fact that the RBI will continue to increase the repo rate, maybe once or twice, maximum 3 times in this financial year, we're looking at a repo rate of around 5.15%. Federal Reserve will, of course, be more aggressive, so I don't think it'll be to the same extent to provide that kind of comfort, saying that there'll be more investors who will be coming to India or not coming to India. So that would be something which is fairly open. We're actually looking at something more in the region of around 78 to 79 if these kind of conditions are going to continue. Of course, there will be something with this kind of a number will have to be reviewed continuously. And unfortunately, the kind of a number which I'm talking of, it's definitely driven by adaptive expectations, because as the rupee keeps depreciating by a rupee, we see that there is reason for us to believe that it will go down by another rupee. But of course, if conditions change, the war comes to an end, crude oil price rolls back, I think this entire scenario will change. And we may also have to we'll also have to revisit the forecast. But as of now, I think 77, 78 seems to be a reality, and not something which is going to be rolled back very soon. So we can probably push it up by another rupee towards 78, 79. Okay, these are my preliminary remarks. Thank you.
Thank you, sir. Very prudent insights from a very prudent economist. So with that, I would now invite our markets participant, Mr. Neeraj Gambhir, Group Executive Treasury, Axis Bank, for his submission, please. Thank you, sir. Over to you.
Yeah, hi. Thank you, Prateek. First of all, big thank you to IIBF, Das Saab, and Ashwini from FEDI for giving me this opportunity. It's really a pleasure to be here, a privilege to be here and talking to the market participants. The topic is very, very topical. Whenever rupee goes through these kind of gyrations, it's standard practice to quote Oscar Wilde, who in his 1895 play said that the chapter on the fall of the rupee you may omit, it is somewhat too sensational. This is what Oscar Wilde said in 1895. So while the chapter on the fall of the rupee may have been too sensational in 1895, I would like to argue that in 2022, it is not at all. So my first point, that Madhav touched upon this. So my first point is that while we have seen some volatility of late, and maybe this volatility is higher than what we are used to, by any measure that you look at rupee's fall, it is actually very, very well contained. And in that sense, rupee has been actually a very well performing currency. So, if I were to look at, let's say, what has happened to rupee in the last 1 month, 3 month, 6 month horizon, we've depreciated somewhere between, if you look at last 1 month, we've depreciated approximately 2%. If you look at 6 months, we've depreciated roughly about 3.5 or 3.7%, right? If you look at JP Morgan Asia Dollar Index, in 1 month, it has depreciated by 3.3%. And in 6 months, it's depreciated about 4.5%. So we are actually somewhat lower than what the Asian emerging market currencies have done. And we are both on a 1 month and 6 month horizon. And if you look at a 12-month horizon, then the number is exactly similar. We have done less than what some of the other Asian currencies have done. And when we talk about Asian currency, we largely talk about China. China has depreciated by roughly 5.5% over the last 12 months. And similar amount in the last 1 month. So most of Chinese yuan depreciation has actually happened in the last 1 month. If you compare us with some of the other, emerging market, economies like Brazilian real, which is depreciated by roughly 9% over the last 1 month. South African rand is depreciated by roughly 10% over the last 1 month and 14.5% over the last 12 months. You realize that we're actually far too stronger than any of these economies. The other measure of volatility that we talk about is basically what the market is expecting, right? Which is the implied volatility in the options market. Now, whenever rupee goes through these gyrations, you look at the implied volatility in options market and you basically compare the implied volatility across various currencies. Even on that measure, if you look at implied volatility, say for example, 3 month implied volatility currently is about it's about 7%. Whereas if you look at any other major currency, even some of the majors like, Japanese yen and euro, even these currencies have a far higher, approximately 2 points higher implied volatility than where we are. So on a forward-looking basis, also the markets are not expecting rupee to be more volatile than what some of these bigger currencies or major currencies have done. Part of the reason this happens in rupee is because we are a managed currency, and we have the central bank who is there in the market to participate on both sides, and that participation on both sides is, while theoretically is designed to make sure that there isn't too much volatility, the realized volatility kind of reflects that outcome. What this does is basically, whenever there are large inflows into the economy, you will see the buildup of the reserves. And whenever there are outflows from the economy, whether it's driven by current account or whether it's driven by capital account, you will see that the reserves are being used up. So in that sense, if you think about this, reserves are nothing but a cushioning factor. It's just the inventory that the central bank is using to manage the flows in the economy. And Reserve Bank has been actually pretty active participant in that sense. Again, I'm probably going to repeat a few points that Madan talked about, which is on a fundamental basis, all factors are pointing towards weakness on the external front, whether it is the increased trade deficit because of higher crude oil prices. And as a large crude oil importing country, we do pay a lot of dollars to buy the crude. Whether it is because of the fact that we are now having a lot more electronic imports, right, over a period of time, and that's added to the amount of imports that we're doing. All of these factors, higher trade deficit, should point towards weaker rupee. Our forecast of FY23 current account deficit, which takes into account both the trade deficit as well as the remittances and services exports, is roughly 3.5% of GDP. So we are actually forecasting a far higher current account deficit this year as compared to roughly 1.5% of current account deficit of last year. Historically, India has had less than 2%. On an average, we've had less than 2% current account deficit. And so this year is going to be a bit on the higher side as compared to our historical ranges. And I think that is kind of reflecting in the market. We also have an added situation where because of the fact that we are in a global monetary policy tightening cycle, we are seeing outflows, portfolio outflows. I would guess after a long gap, we are seeing such sizable portfolio outflows. I think the estimate is somewhere close to $22 billion so far over the last, I think, 12 odd months or so. And these are sizable portfolio outflows. In the previous cycle, this size of outflows would have resulted in a massive impact on the currency. But if you see in this round, we have not seen these size of portfolio outflows having any impact, because effectively the central bank has used its reserves to cushion the outflows and cushion the market away from the impact of these outflows. So that's the second aspect. The third aspect, obviously, is the FDI. FDI continues to be strong. We might see a slightly lower FDI this year, but there are things like production-linked incentives and a whole host of other things which are going around in the real economy, which should effectively mean that the FDI flows will continue to be relatively robust, and certainly much more robust than what we have seen about 5-7 years ago. What does all this mean from a balance of payments perspective? It basically means that unlike the last 2 to 3 years, this year we will see a deficit as far as the balance of payments is concerned, right? We will see a net negative. And our estimate of that net negative of balance of payments is closer to about $25 billion. Therefore, even if you don't account for the leads and lags in the economy and the hedging, etc., that happens, we should expect somewhere close to $25 billion worth of drawdown of reserves this fiscal year, right? Now that can happen in the first part of the year, second part of the year. It depends upon how the actual flows play out, but we should at least be prepared for that level of reduction. We have actually already seen that level of reduction in some senses. So we've seen the foreign exchange reserves come down by roughly $45 billion. Our estimate is that roughly half of this is on account of actual outflows and half of this is on account of valuation of reserves, because Reserve Bank does hold a large part of their holdings in non-dollar currencies. And since the reserves are being counted in dollars and dollar has been strengthening against other currencies, so our reserves have seen a valuation drawdown. Now, how do we sort of think about the outcome on the rupee going forward? I think we are still in a scenario where United States is going to be one of the most aggressive central banks as far as the normalization of policy is concerned. And the reason for that is that if you see the amount of increase that they have seen in terms of their inflation, it's quite substantial, right? They were struggling with getting the inflation up to roughly 2% in the last decade, post-global financial crisis. And suddenly their inflation is somewhere between 7 to maybe 6 to 8% band. So that's a 6 percentage point increase in their inflation. And while they characterize for the last full year the inflation as transitory, I think that characterization has undergone a dramatic change since March of this year. And clearly now the central bank is worried about the entrenched nature of the inflation, and therefore they are going to take far more aggressive actions, whether it is the hikes in the policy rates or whether it is the reduction in the balance sheet. Compare that with some of the other global measures. We are not seeing that level of aggression in terms of normalization from ECB. Japan still continues to be in a very sort of dovish, soft policy mode. They are unlikely to sort of tighten up in any meaningful way. So most of the global central bank tightening is driven by what Fed is going to do. We have a few other central banks like Australia, New Zealand, Canada joined this bandwagon, but the other major, and maybe Bank of England, but the other central banks like ECB, etc., are probably somewhat going to be slower. And that's reflected in the way the market is pricing in central bank intervention or central bank sort of policy rate changes. This will in all likelihood continue to have some kind of a negative impact on portfolio flows. We've seen that in the past, that whenever the US policy tightens, there is a reversal of flows from the emerging economies. The global capital goes back in to the safe haven assets. And there is in general an increase in the risk across the markets. And, it kind of is some kind of risk off sentiment starts coming into play. I think this cycle has so far been very similar to what we have seen in the past. Therefore, as far as the external environment is concerned, global factors are concerned, I think they will continue to be negative. I have already spoken about the fundamental factors, which is basically the fact that our trade deficit is negative, our current account deficit is going to be much more negative than last year. So that's also a sort of an impact that we have to take into account. As far as the actual demand and supply of US dollars in the market is concerned, I think we have so far seen some kind of reluctance on the part of exporting community to participate in a meaningful way in the markets. I think most of the exporters are of the opinion that since rupee is likely to depreciate more, they are kind of holding back from hedging. And I think these flows are on the sidelines for the time being, and they'll probably wait for a better time when the conviction is there that the best part of the depreciation is out of our way. At the same point in time, we have seen consistent, sort of hedging demand from importers, if not too long-term, at least to some short-term demand. And this sort of imbalance in the market has created some kind of additional demand in the system, right? And that's again what is getting reflected in the way sort of rupee has sort of moved in the recent past. My estimate is that given the fact that Reserve Bank has already intervened to the tune of roughly $25 billion, as we can see from the reserve numbers, a good part of the BOP negative is kind of taken care of in some senses, right? And therefore, what we may see in the time to come over the rest of, let's say, 10, 11 months, may be far smaller than what we have seen in the first maybe 2 months so far this year, or first 1.5 months this year. In any case, the months of April, May, June tend to be cyclically weak for the currency because most of our flows are bunched up towards the second half of the year, and that too in the Q4. So Q1 typically tends to be the period when rupee is usually quite weak, and this time around I think that is also getting quite exacerbated. So as long as global factors remain well contained and on the expected path that the markets are pricing in, which means that the crude oil prices hover around $100, maybe $100 to $120. The monetary policy cycle, tightening path of US Fed is along the lines that the market is expecting, which is basically a 50 basis point hike over the next maybe 2 to 3 meetings, and a balance sheet runoff, which is already well advertised by the Fed, which is, at the peak, it'll go up to about $1 trillion over the next 12 months. And the other central banks are also sort of sharing the same course. I don't think that we should see from here onwards a very significant amount of depreciation on the rupee, right? I do feel that expecting anything more than 4 to 5% of depreciation in a given year is quite a bit, and historically that has not been the case. I think that is kind of borne out in the kind of forward volatility estimates that we see from the option markets. Even a 12-month vol in India is about 6%. So that's in the same ballpark. So I would think that, after we have seen the level of depreciation that we have seen, after some time when the market has settled down, we could see a very well contained path of the rupee. And therefore, I wouldn't expect us to depreciate too much. In any case, I think Q3 and Q4 tend to be far better periods for rupee because the flows actually resume in a bigger way during that period. Having said that, I think we are in a very uncertain time. We are in the midst of a war. There are very strong factors globally which are at play. One factor that I would like to call out is that we haven't seen this level of quantitative tightening ever in the past. While in, I think, 2015, Fed did some bit of quantitative tightening, but it wasn't of this scale. What are going to be the effects of quantitative tightening on the markets remains to be seen. So it is quite likely that we might see increased volatility as the actual balance sheet reduction of the Fed plays out, right? Also, if the geopolitical risk exacerbates from here, in any way, we could see a spike in crude oil prices and in general commodity prices, which may actually further impact our external factors negatively. So we need to be watchful of these factors. But barring these factors, if the markets play out as expected, I would generally guess that the volatility in rupee should subside over a period of time, and I think we should see we should expect some depreciation, but not of the order that we've seen in the first month and a half so far. So I'll just pause there and happy to take any Q&A after this.
Thank you, sir. Very insightful again. So with this, when Madan sir is saying an economist point of view that we will be seeing dollar at around 78, 79 level, you have given a market perspective that there won't be too much of a depreciation. So with that, I would just open the podium to for a panel discussion. We will deep dive into the trajectory of Indian rupees in 22-23. So I would request Mr. Ashwini Singhani, the Chief Executive, Foreign Exchange Dealers Association of India, to take over and give us a few more insights on the trajectory of Indian rupees. Over to you, sir.
Thanks, Pratik. And good afternoon, everybody. And at the outset, I would like to convey my thanks to IIBF for organizing this event, and also to Mr. Madan Sabnavis and Neeraj for accepting our invitation and joining us for this discussion today. So taking the topic forward, I think it worked out based on what you have mentioned. I must acknowledge that your thoughts, these are quite comforting, especially in the last 1.5 months, 2 months, when we have seen a sudden spurt of depreciation and so much going around all over the world and high level of volatility. When you say that, especially in Madan's words, if I can say 77, 78, and maybe we'll revise it by 1 rupee, 78, 79, even that sounds very comforting to our ears. And then again, Neeraj also mentioned something that the volatility is quite low, and if the things work out the way we are expecting, maybe you may not see the kind of spurt which we have seen in the last 1.5 to 2 months. But, I think sometimes having been in the market for long enough has got a different memories keep flashing in your mind. So when I'm keep reminding of myself and about 2013 scenario, what we saw when we used to talk about the rupees, fragile 5 and other sort of thing. Though today what we heard about is that we are somewhere in the median as compared to the other currencies, as compared to the rest of the market, we are doing relatively much better. So one thing which comes to my mind, Madanji, if I may ask you, you mentioned about the capital flows and other things. Though we all know FDI may continue to be at the sustainable level, almost not much shift in the FDI, but FDI clearly we are seeing the outflows, major outflows, which we have seen, and we feel, as Neeraj also mentioned, as the US dollar strengthens globally, this experience tells us that market goes into the risk off mode, which means pulling out all their investments from the emerging markets and developing countries back to their home country, and we are already seeing that trend. With that thing, FPI probably turning into negative, and ECB also, you have mentioned, is unlikely to grow going forward, especially because of depreciating currency, high hedging cost. Do you see the possibility, though you have mentioned current account deficit at 2.5 to 3%, though Neeraj had slightly more conservative view on that of 3.5%. Do you see the possibility of country going into, once again, are we looking at the twin deficit kind of situation? And how is it likely to affect our country rating as a whole? Though I know at this point of time, nobody is talking about that. Do you see that possibility?
I think what you have said is right, that we are going to have the twin deficits. One, we know that the fiscal is already strained, and they are trying their best to make sure that we are what we have targeted. But in terms of current account deficit, I think the situation which you spoke of in 2013 and today what we're talking of 2022 is quite different. Because I think the kind of a reservoir of forex reserves which we have today, which we have built assiduously in the last 5 years or so, does provide a lot of comfort that even I would say, even if I go by Neeraj's number of 3.5%, it's not a very comfortable number, but 3.5% current account deficit is definitely something which is sustainable. Because we all know that what we're going through today is not a permanent situation. It's a very temporary, it's a kind of a random shock which has come through. It's caught everybody unaware. It's like none of us knew 2 weeks back that we would be depreciating like what's happening today. So maybe the things could just cool off over the next couple of months or so. So I don't think there is a fundamental weakness as such in our fundamentals. So pardon me for using these kind of words. Like if I go back to 2013, there was a problem which we had even in terms of trade, in terms of our capital flows. So today what we are seeing here is going to be more an aberration, which we're seeing even in terms of, say, FDI stagnation, ECB is not picking up, or your FPI, or even the current account deficit increasing. So I think the overall conditions, because the economy as a whole, I won't say it's very, very strong or something, but it's definitely much better than what it was, not just in 2013, but we have come out of the pandemic also fairly well. It's a fairly strong economy. There are, of course, it's not an easy economy because inflation is obviously a worry. So that's something which could shake the apple cart. But on the whole, I think the external account is not as scary as what it was earlier. So that's what gives confidence that what we're seeing today can be taken to be more of a temporary shock rather than something which is which has permanency, which can actually damage the external account.
Thanks a lot. That's I think makes it a little more, adds to the comfort what we were thinking otherwise. Neeraj, if I can come back to you, you mentioned about that US is clearly, we all know, is more aggressive in terms of normalization. And many of the European countries who are just simply following the US, and India also, we have seen already a 40 basis point hike, and we are expecting maybe another 50 to 75 in the year, where US is still, people are talking maybe 150 to 200 basis point kind of thing. With that situation, I see the differential between US dollar and Indian rupee is obviously going to narrow down. Does it make, going forward, does it make it less attractive as a destination for FPIs, especially when they're looking at debt portfolios or otherwise? Is it likely to have an impact in the future flows? Any take on that from the market? Because whenever anybody is sitting in that regional or the global desk, he will be looking at multiple emerging markets, not just India. How does India fare vis-a-vis the other economies or the markets where we compete for these kind of investment and the flows? Any view on that? Any feel you are getting on this?
Yeah, so I think what I would like to argue is that if you look at US bond market yields, they have already reacted quite sharply to the readjustment that is going to happen as far as their policy rates is concerned, right? We've moved from roughly 140, 150 to 3% handle, right? We're slightly below 3% right now, but we did touch slightly above 3% and we've come off. So we are around, let's say, 280 to 90 to 3% level. And on the domestic 10-year bond yield, we are at around 7.5 right now, so say somewhere between 7.25 to 7.5. So we are at about 425 basis points differential, right? Depending upon which day you look at it, you could be somewhere between 425 to 450 basis point differential between the onshore bond yields and the US dollar bond yields. That's the kind of historical norm. It's not widened in a significant way. Or rather, it's not compressed in a significant way for us to start worrying about the fact that the differential is something that will motivate people to go, to prefer US dollar investments more over the fixed income, India bonds. So I think we need to continue to watch this, but at the moment, I can't think of that as the reason. You will then probably extend the argument to say that then why haven't we seen FPI flows into fixed income markets, right? I think the rationale for that is quite clear. One is that as the global inflation cycle was playing out, I think there was this whole, expectation that the market has that the Fed will need to pivot and pivot in a big way. that pivot has materialized. I think over the last month and a half, that pivot is materialized. We've also seen Reserve Bank of India and MPC pivot, and that pivot is also materialized in a meaningful way. And that, to my mind, should add to the foreign investors' comfort that Indian Central Bank is also, after all, serious about inflation management, and they will not allow inflation to go out of the hand, which is a huge concern that the fixed income investors have globally. I think we need to just wait and watch a little bit longer for these things to settle down. I think we've had these pivots happen across the world in the last month and a half alone, right? So it's too fresh. I think the markets need to settle down. They need to absorb these pivots. They need to understand how far the central banks will go in terms of their policy actions, and what is going to be the impact of these policy actions on the underlying economic, parameters, particularly on growth. And I think I would only once these things have been internalized, I would see some kind of a reversal of flows. Investors have been sidelines as far as Indian markets are concerned, but I do expect that the attractiveness of the market will, come back once these things have been internalized and the markets have settled down.
Okay, thank you. One more thing which came to my mind while going through that talk of yours, we both have talked about that current reserves, which are much more comfortable than what we used to have earlier, and maybe the quality of reserves also is much better than what we had seen historically. And we talked about that in the last few weeks, reserves have dropped by something around $40 to $50 billion, and maybe part of that is because of intervention and part because of revaluation of the currencies. So one thing more besides the reserves which comes to my mind is today, in the past 2 years, the kind of changes and the relaxations what central bank has brought into the country. Now our market is much more well integrated with the global markets, especially if you look at dollar rupee also. If I say now access to the NDF market is there, which earlier was not there. With these kind of things, obviously as a trader, you will have access to that market now, which earlier both the market used to work in isolations, and there was some lead and lag effect also. And as a central bank also, they had to do all the intervention or all the action they needed to do through the domestic deliverable market. Now everybody has got access to that market. And in fact, about some of the newspaper reports, they were also speculating. I don't know, nobody will be in a position to confirm or deny that maybe the central bank has been using either the futures market or even the NDF market for the intervention purposes, as a result of which our reserves are not showing the actual level of intervention. Any take on that? How this integration is helping manage the volatility much better, or helping the country economy, maybe for the markets behave in a much more mature and stable manner, keeping the volatility low? Or any views on that? Any take on that? Both of you, I would like to hear from maybe Neeraj first.
I think I'll completely agree with you that this has been a very positive development as far as the management of currency volatility is concerned, right? I'd like to argue that the fact that today there is a linkage that has been established between the NDF market and the domestic market by permitting the domestic banks to participate in the NDF market has ensured that the volatility is well contained. Otherwise, what used to happen in the past was that whenever there was a dollar strength, EM currencies used to come under pressure, you would see the implied valuation, or rather the implied spot rate in the NDF market would trade at about, somewhere close to 10, 15, 20 paisa differential in the very front end of the curve, right? So you would have 1 month trading at 15, 20 paisa differential over the onshore rate. Now that even in the most volatile times, we've seen the differential barely budge, right? It's at most of the days is actually zero. So effectively, this has reduced the spread that offshore market used to have over the onshore market. And we know in the past that that spread used to act as a self-reinforcing mechanism. So most of the Indian traders would walk into the dealing rooms at 9 o'clock in the morning, look at what's happened in the NDF, how much is NDF trading away from the spot, and then that would sort of set the tone for the day. Today, you don't do that, right? Because the NDF market is very, very close to where the domestic onshore market is, right? So that has reduced the self-reinforcing behavior that used to come into play earlier. It has also, as you mentioned, there has been speculation in the media that it has also given the central bank tools to intervene in the market, multiple markets, and have different sort of strategies of the intervention and make sure that there is a optimized outcome of these interventions. Remember, participation in the currency futures market and the NDF market does not draw down reserves, right? So it's also a reserves efficient, quote unquote, a reserves efficient strategy of intervention. So I would like to argue that it has increased the flexibility, it's increased the degrees of freedom. And as it has increased the degrees of freedom, I think the ability of the Reserve Bank to intervene has improved. And that's also probably getting reflected in the way the markets have behaved.
Just to add to this, I would say that, I remember 2013, I think lots of us did feel that the blame was really in the NDF market. And they're saying, look, we have no control over the NDF market. So conditions in the domestic market were all going according to the plan which the RBI had. But then you say, look, something is happening in the NDF market, and that's what's really leading to this differential and then speculation, which becomes self-fulfilling. So I think the kind of financial innovation which is there today with the RBI, not just looking in terms of offloading reserves, but also getting into the futures in the NDF market, opening the market of the MDF market for the domestic banks. I think that has made a big difference. And I think that's a very good thing which has happened, because you're able to, rather than sit back and say, look, it's the NDF which is responsible for it, you make that more organized in terms of the players, so that the differential which is there between the two markets gets narrowed down. So I think this has been a good way of trying to react to the volatility which is there in the market without really losing your reserves. So I think that's been a benefit for us.
So I can say that in a way, whatever the initiatives or the measures have been taken in the past 2-3 years, or maybe the learnings from the previous episodic events, those are helping us overcome this kind of turbulent times in much more efficient and better way. That's good to hear that. Then one thing more, I think, Madanji, you have mentioned about, normally I know that people avoid giving any particular levels, though with proper caveats and disclaimers. You talked about 78, 79 and 77, 78. Neeraj, if I may ask you, as a trader, would you like to give a range where do you see that this is the level? We know RBI has been all along very clear that we are not targeting any level. We are only trying to curtail the volatility, which is their stated objective. That's very clear. But we all know that somewhere it becomes a pain point. If it goes beyond this, we as a country start suffering, though the export competitiveness is one point which people give, but we all know that's a very short-term relief, whereas on the imports, it hurts me more. On the inflation side, it hurts me more. So somewhere it becomes really unbearable, beyond which we can't let it go. Or would you like to guess something like that? Would you like to comment on that, please?
I mean, when it comes to forward forecast, I think I always go by the forward curve, right? And my arguments always have been that there is a forward curve out there, which all of us trade. As long as rupee that forward curve gets materialized over a period of time, it should be okay, because then that forward curve materialization basically means that you're kind of neutral between hedging and not hedging, right? The moment the rupee volatility or rupee sort of depreciation exceeds that forward curve, right, that's when the problem sort of starts happening. So while people put an absolute number like Madan did, I would say that I would watch out to see whether the forward curve is materialized or not, or how far away do we trade from the forward curve over the next, let's say, 3 to 6 months time frame. I wouldn't want to put a number on it. I think everybody can compute it, but I would think that that's a good way to think about for any importer or exporter to hedge his flows, right? So if you're an importer and if you expect the rupee to trade beyond the forward curve, then please by all means go and hedge, and vice versa for the exporter.
Thank you, but that's paying upfront premium is always the most difficult thing for our importers. As you also mentioned that importers are doing only the short-term hedges where exporters are holding it back. That had been the chronic problem in the market. And I think we'll continue living with that. It's nothing is going to change on that front. So one thing, Madanji, I'll come back to you on that. You have mentioned that, again, coming back to being in the market all along, we people especially the frontline people, unlike economists, we are so stuck up with the absolute numbers. So I'm once again coming back to that. I hope you don't mind. So would you, if I say that for dollar rupee to trade back towards 76 in next 3 months time, what are the things, if it materializes, maybe you see the possibility of dollar rupee going back towards 76 or low? That kind
In
of
fact, if the value is to go back to 76, I think what will have to change will be the fundamentals, because when we are talking in terms of the dollar strengthening, that is a given. That's going to continue for the rest of the year. So the external factor which is affecting the currency is not something over which we have any control. That will remain where it is. But that's not going to change. But however, if we are looking in terms of the war coming to an end, or the commodity price reversal taking place, the kind of a spiral which we have seen, and we see an improvement happening in terms of a current account deficit, and we probably end up closer towards 2.5% and 3% rather than the 3.5% which Neeraj spoke of, I think that will provide a lot of comfort. Similarly, I would tend to believe that there is, of course, a case of saying that my capital flows, especially on the FDI front, not so much on FPI, because as long as the Fed keeps increasing rates, there will be a tendency for the FPIs to remain negative as far as India is concerned. But there would be a case of saying that with normalcy returning to the world economy, to the world at large, there would also be a case of saying increase. So when my fundamentals increase and we see that the dollars are flowing in, then there could be a case of saying that the rupee will actually revert towards the direction of 76. Because the external factors, I don't think that's going to change. It's more or less given. So, and I'm also not quite sure how happy the RBI would be in case the rupee was to go towards 76 at a time when there would be depreciations happening as far as our competing nations are concerned.
Maybe we'll see the intervention on the other side, but no, that's with that. I think now, Pratik, if you have any questions from the audience, would you like to take it up?
In fact, just before we take it up, just to draw an analogy, what's happening in the money market. We have seen that RBI is increasing rates to make sure that cost of capital is higher. You want to bring down inflation. And yesterday we read that the RBI is trying to go in for buyback of securities to provide liquidity to make sure that GSEC yields come down so that the government can borrow at a lower cost. So I think these kind of ambivalent kind of moves would be expected also in the forex market at some point in time.
In fact, that reminds me of the economic trilemma. If you can give a little views on that, it is always a nightmare for any central bank to balance between these three glass balls: interest rate, exchange rate, and the capital flows. In the situation where we are today, what do you think if it comes to something has to give in? What is your take? What would be the first one to be compromised?
Hard question, actually. It's a very hard question to really answer. So where do we compromise? Because the capital flows coming in, yes, they are required. You cannot really stop them if they're coming in. So I think it will be a case of currency intervention more likely.
Neeraj, any take on that? You're on mute, I think.
Sorry, I think we are somewhat far from thinking about any sort of administrative measures to stem the volatility as yet, because two reasons. One is that it's a global phenomenon. It's the dollar strength and the commodity prices that is playing out. It's not a very idiosyncratic move as far as India is concerned, right? So if we step in with some kind of administrative measures at this stage, with it would kind of give us impression that we are kind of panicking, which we don't need to. Given the sufficiency of reserves, given the low size of external debt that we have, etc., I think I would think that the intervention will continue to be the preferred means of managing the volatility rather than administrative measures.
Thanks a lot. I think that's very well put. Thanks, Madan. Yeah, Pratik, would you like to take it up?
I think there are a few questions. Pritam, you can read out.
Yes, sir.
Participants.
First, I will start with the question raised by Mr. Amit Gupta. How do you see the turmoil in Sri Lanka? That is it really an economic slowdown as it is being presented, or is it a political move by the opposition group? I think I'm not sure whether this question pertains to this forum, but I'm open to anybody answering that question. Or rather, I would rephrase this like, say, the turmoil that is happening in Sri Lanka, that basically pertains to a serious pressure on the foreign exchange reserve, right? But will you actually foresee such a scenario establishing in India?
No, actually, no, because I think this is a pertinent question, because if you see the crisis in Sri Lanka has happened primarily on account of a total collapse of the balance of payments. So in fact, if my memory goes back to when I just started my career, it was in the early 90s, when we did have a problem of balance of payments, when we went in for economic reform. So this situation is quite analogous to that. And Lanka is a different kind of a country which is heavily dependent on imports, heavily dependent on aid. So I think that's why we have had the situation. Because a country like India, where we are generally self-sufficient, I would say we are probably dependent, maybe about things like crude oil. Otherwise, if you look at most of the goods are actually being produced in India, we are not in a situation where we will collapse. So therefore, I think we cannot really draw such a parallel. I think India is very, very much different from what's happening in Lanka. Lanka is a much smaller economy, fully dependent on the external world. So when your dollar reserves come down, then you really have a problem. So we can't compare 600 billion with, say, the 50 billion which they have defaulted on their debt. I think that may not be right.
That's very assuring, sir. Next question that comes, it comes from Mrs. Gayatri Harikrishna. So she is asking, do you foresee Fed Reserve to become less aggressive with rate hikes, provided the growth data being negative in the first quarter? That's what she's asking.
Yeah, I think, there is obviously a market implied Fed tightening that is out there, which is currently speaking about 50 basis point hike in the next 3 meetings, if I'm not wrong. And there is obviously a dot plot based terminal rate that the market is thinking about. Fed, clearly, I think they have become far more serious about inflation. And even if there was a somewhat of a growth slowdown that we were to see in numbers, I don't think that will deter them too much from pursuing the path that they have already laid out. The only situation where we've seen in the past Fed actually step back from such tightening cycles is when, in their assessment, their financial conditions in US tighten significantly. And one of the factors, and there are multiple factors that they look at in terms of financial conditions, one of the factors happens to be equity markets. The other factors are typically, for example, credit spreads on junk bonds, high yielding bonds, etc. Volatility in the equity markets. So if all of these things point toward a very significant tightening of financial conditions, and the economy has cooled off to a certain degree, and if in their assessment the forward path of inflation starts looking more benign than what was initially estimated, I think these could point towards a less aggressive Fed at this point in time. But I think we're somewhat far from there. Even though people used to talk about a Fed put, a Powell put being available at 4,000 S&P. We've seen S&P break 4,000. We've not seen any sign of that put. So I think it's clearly evident that Fed is far more serious about their role as far as management of inflation is concerned and the path that they're likely to take.
In fact, I feel that Federal Reserve cannot go back on what it has already said. I think because I think the statements made by the Fed are taken seriously all across the world. And just tomorrow, if you say that they decide that, look, we're not going to we're going to roll back, we're going to sit back and not have any more rate hikes, I think it'll distort the markets very, very severely. So everything's going to go topsy-turvy. So I don't think the Federal Reserve will do such a thing. Even in case conditions do improve substantially, it'll be.
Okay. And she asks another question, Mr. Gayatri Harikrishna. Will the world economy fall into recession? Now, that is a very deep diving question, basically. So what is your view on this? Is there any probability of the world economy as a whole, with this geopolitical tension and the spiraling fuel prices, will there be any possibility of recession?
It's always possible. I don't know what the probabilities are. I think if you basically think about the fact that Fed is going to take the rates to about 3.5% over the next, I would say, 12, 18 months, right? There is going to be a very significant quantitative tightening of their balance sheet. Now, significant in relation to what we have seen in the past, not significant yet in relation to the expansion of the balance sheet that we've seen in the last 2.5 years. I mean, the Fed balance sheet has virtually doubled in roughly since the onset of the pandemic, right? And what they're doing right now is take out about $1 trillion out of that. So, but like I said before, we still don't know what the full effects of quantitative tightening are going to be. Neither does the Fed. I think they've acknowledged that. So we will have to see how this plays out. I would be more mindful of seeing the impact of the QT than the hikes. The hikes are in the price. They're well articulated. The impact of the QTs remains to be seen, right? So if US economy goes into recession because of the aggressive tightening by the Fed and the quantitative tightening, will it drag other economies into recession? Possibly. But I don't see us in India going into recession anytime soon, right? I think we're still in a fairly healthy growth rate. We might see some tapering down of the growth rate. We might see some tapering down of the demand because the rates are going to go up now. But I don't expect us to be falling into recession anytime soon.
I have a slightly different view here because I think that the world economy will definitely not slip into a recession. We should remember that all this talk of saying that the world economy or any economy going to a recession is premised on the fact that central banks are tightening too tightly, means increasing the rates or doing whatever it is to slow down the growth in the economy. And now all the moves which are being made by the central banks are being done in a calibrated manner. It's a fine-tuning process going on every 2 months or so. You sit down and decide. So the once they feel that the economy has slowed down to what they want, at the level which they want, I think the tightening itself will automatically become weaker. So therefore, we could also expect a change in the policy stance taken by central banks across the world. So I don't think it's a case of saying that we increase the rates today in the world and this recession is going to happen tomorrow, because a recession, let's get that very clear. Recession is 2 quarters of negative growth. So what we're talking of is something which is more serious than just a slowdown in growth. India slowing down from 8.9% to 7.2% is definitely not a recession. Okay, and I think that's the sad part. I think there's a lot of hype which has been put to saying that is India going towards stagflation, which is a recession and high inflation. Let's clarify first what a recession is. Technically, that's what a recession is. Like during lockdown, we did have a recession, negative growth rates in 2 quarters. So I think governments and central banks are going to be mindful of it. As they're approaching the first quarter of negative growth, there will be preemptive action taken to make sure that the ship is steadied.
Okay, thank you, sir. So another question that Manish Gupta had asked earlier, is there any correlation between Indian rupees and Chinese yuan? So both these currencies are falling vis-a-vis dollar. So can we actually foresee a correlation? Sir, Madan, sir, you are on mute, please. Yeah.
No, I think statistically it would probably follow, as I said, that when the dollar tends to strengthen, Chinese yuan as well as the rupee have both tended to depreciate. So if I do a correlation, a statistical correlation, I may come to a positive correlation. I think it will probably be strong. That will hold with lots of other currencies, but I don't think the two of them are directly related. That's my view.
Okay. P. Hari Kumar, he asks, with the introduction of CBDC, do you expect the inflation to come down?
No, I don't. Neeraj.
You know, I was about to say that CBDC is quite some time away as yet, right? I'm hoping to see some kind of pilots being launched in India this financial year. And for CBDCs to reach a stage where we can talk about its impact of inflation is still quite some time away. I think it's a concept many central banks are still grappling with how to introduce. There are still discussions around the benefits and the costs of having a CBDC. In India, we've announced that we're going to do a CBDC, but I think the first step will most likely be some kind of pilots being run to see how it will work out. And only over a period of time do you see CBDC sort of play out in a bigger way. Even if it does play out in a bigger way, and I'm not sure I'm in a position to comment about its impact on the inflation, but think of CBDC as an electronic form of the cash which is sitting in your wallet, right? So as long as it's just an electronification of the cash which is sitting in your wallet, should it have a substantial impact on the inflation in the economy? It's hard for me to say, but it looks a little difficult that it would have a big impact either ways on the inflation or inflationary expectations. I don't know, Madan, you have a different view on this?
No, actually, I have exactly the same view. CBDC is nothing else but the rupees which are carried in my wallet. It's going to be in an electronic form. There's no reason why it should increase inflation or decrease inflation. Only to the extent that money is being controlled by the RBI at the moment, it's CBDC, to the extent that there is black money which is circulating and leading to inflation. And we should remember one thing, that when black money leads to inflation, the fact that it's unaccounted, we'll never know that it's happening. So therefore, I think that we will not be having higher inflation on account of CBDC.
Yeah, we also don't know how much will be the taker. What is going to be the adoption, right? Because there are pluses and minuses of CBDC. Remember, CBDC by definition means lack of anonymity, right? Cash gives you anonymity. So we don't know what will be the extent of taker.
Okay, thank you, sir. I think the discussions have been so extensive that it almost covers all the questions that has been asked by the participants so far. So if there is any questions to be asked by anyone else, kindly raise your hand. I will enable the provision so that you can ask the questions yourself, please. Can you raise your hand? I can see.
In fact, there's an interesting thing which I can see on the screen is if the CBDC can be traded as crypto. No, the two of them are totally different. Okay? CBDC is going to be issued by Reserve Bank of India. It cannot be traded. It's just your currency. So it's not a crypto.
So I can see Mr. Ashok Kumar Mittal raising his hand. So I have, if you can unmute and speak, Mr. Mittal.
Yes, are you hearing me?
You can ask your question. Yes, we can hear you.
Sir, I have posted a question that India and Russia is forwarding ahead the rupee-ruble trade settlement. So how you see the impact on dollar?
So India, Russia, rupee-ruble arrangement. Will that have any impact in the INR rates, sir?
I don't think so. I think the rupee-ruble arrangement will help to make sure that whatever trade takes place between the two countries will take place in a smooth manner, because there are a number of companies which have exported to Russia and are waiting for payment. Similarly, we are importing oil from Russia, which will be probably paid in rubles. So it will be more a kind of a bilateral arrangement which takes place. I don't think it will have an impact on other currencies. Neeraj, you can have.
I think I would like to caveat. I broadly agree with you, Madan, but I'd like to caveat that by saying that if our attempts to establish a rupee-ruble settled trade corridor with Russia is seen very negatively by the Western powers, right? And if it comes down to them, therefore, imposing some kind of sanctions on India, I see that as a low probability event. But under those circumstances, you could see some impact on dollar-rupee exchange rate. But barring that, I think the size of the trade per se should not be a factor.
Okay. I can also see Mr. Ashok Triveni raising hand. If you can please unmute yourself and speak. Mr. Triveni. Okay. So if there is any other question, you can post it now. Okay, Mr. Kanhaiya Jha is speaking. For how many more months do you expect FPI outflows to continue from Indian market? With rate hikes from RBI and other central banks in the offer, where do you see rupee in next 2 months? I think that question has more or less been discussed. So, Mr. Jha, I think it has been discussed. So, for benefit of everyone, we will just try to inform that the whole session that we had discussed so far, all the discussion will be put up in our YouTube page. So you can any given point of time, you can access that and go back to the previous discussions. So with that, I think we have come to the end of our sessions, our question answer round. So now I would ask Dr. S. Muralidharan, Director Academics, to sum up and provide the vote of thanks. Over to you, sir.
Thank you, Preetham. And it was really a wonderful session by two experts and excellent moderation by the Chief Executive of FEDI. Just for the benefit of all, I'll just walk all of you through some salient features made by the two distinguished speakers. Mr. Madan Sabnavis based his speech or his views on basically four factors, namely fundamentals, external factors, what RBI is expected to do, and his thoughts on the real effective exchange rate. Speaking on the fundamentals, he said that the trade deficits are going to rise. If imports exceed rupee exports, the demand for the dollar will increase, leading to a depreciation in the rupee. If the current account deficit is around 3.5 to 4% of the GDP, again there will be pressure on the rupee. External commercial borrowings may not be the preferred route for Indian corporates to raise funds, and the pushbacks will also see the rupee depreciating going forward. So in his opinion, the rupee may settle around 78 to 79, not beyond that. Mr. Gambhir, he made a mention about when compared to other currencies of other emerging economies, rupees is a relatively better performing currency in terms of less volatility as compared to other currencies in the emerging markets. And in his opinion, the rupee may not be very volatile, but however, there are weaknesses on the external fronts due to which higher trade deficit will be there, is expected to be a reality, which in turn will weaken the rupee. He also said that the exports, the deficit will be around the exports presently, which is constituting about 3.5% of the GDP. The exporters are holding up on hedging as they expect rupee to depreciate further. So there will be some external pressures, and in his opinion, the Federal Reserve is going to be one of the most aggressive central banks in the world. And basically what it does in the near future will be keenly watched by other countries, including that of India. And he also further elaborated that generally Q1, the rupee has been weaker, and in Q3 and Q4, it's better than the rupee. Basis the expert opinion of these two dignitaries, Mr. Ashok Sindwani very skillfully led through a moderation session we asked, wherein the questions which he asked flowed from the speeches given by the two dignitaries. And basic thing was that past learnings are helping us to better manage the current situation. And going forward, although there will be pressures on the rupee, but India is relatively a better managed economy. One of the main reasons is that we are self-sufficient, unlike some other smaller countries like Sri Lanka, which is witnessing a complete economic and political upheaval. So I think going 6 months down the line, we should see better performance on the Indian economy. With the pandemic, the effects of the pandemic weaning away, hopefully there will be no fourth wave. We should see a situation where the rupee emerges stronger. So basically, it was a wonderful session and a very contemporary topic, as all of you have suggested. And in this regard, I would like to place my sincere thanks to both CEO IIBF and the chief executives of FEDI, who after quite a good discussion, we arrived at this topic, because we had shortlisted about 3 to 4 topics. And basis of our discussions and with Mr. Madan Sabnavis and Mr. Neeraj Gambhir, we concentrated on this topic. And looking into the consideration, looking into the extent of registration which has happened, really it was a very thought-provoking session with some very intelligent questions being asked by the participants also. So going forward also, we will hold such joint webinars with FEDI and other institutions. So on this occasion, I, on my personal behalf on behalf of IIBF, would sincerely like to thank Mr. Madan Sabnavis, Chief Economist, Bank of Baroda, Mr. Neeraj Gambhir from Axis Bank, the Group Treasury Head of Axis Bank, Mr. Ashok Sindwani, Chief Executive FEDI, my CEO, Mr. Biswaketan Das, and all the participants, and my colleagues, Preetham, who did a wonderful moderation session. And I would really thank all the participants for a very enlightening session. And as Preetham has said, the key takeaways of this will also be placed on the website. And the recording of the speeches given by the two distinguished speakers and the excellently moderated session by Mr. Sindwani will also be placed on our YouTube for greater dissemination at your own free will and at your own convenience. You can listen to them and it will certainly enhance their knowledge going forward. So thank you one and all for this session. Thank you.
Thank you all. Thank you, sirs.
Thank you.
Thanks.
Yes,
Thanks,
thank
Thank you, everybody.
Mr. Sidwani.
Thank you, sir. Thanks very
So this
much.
brings us to the close of our session. Thank you all for your participation, and we'll look forward to your participation going forward also. Thank you.
Thank you. Thank you.